Hi friends, we are starting a face-to-face offline batch in Bangalore with SS Academy. That is for CA Final Financial Reporting paper number 1. Yeah, we'll be taking exactly 2 months from 1st November to 31st December. We'll complete it. It is starting from 1st November 2022. Yes, and in Jayanagara branch of SS Academy, we have morning batch and evening batch will be at Seshadripuram SS Academy. Right, and if the student is missing because of any reasons, right, they are going to get a backup class. All right, we'll ensure that their things, they will study and complete. And from the face to face batch, you know the benefits out of it. We'll be completing the syllabus in time. You don't need to postpone and you don't need to compromise for your goals. See you in the class. Please share this information with your friends. That will help me and as well. Thank you. Yeah, hi friends. Let's have a look at Ind AS 28, that is investment in associate and joint venture. Yeah, see, if we have investment in associate or it is in the joint venture, correct, now then you are supposed to refer to Ind AS 28 for that accounting. And this standard is obviously applicable when the company is preparing the consolidated financial statements. Yeah, if they are preparing the same, if they are preparing the standalone financial or separate financial statement, yes, they can measure the same investment at cost, right, at cost or at fair market value as per the Ind AS 109, that is as per Ind AS 27. Yeah, you are coming to 28 means, as I said, you are following the consolidated financial statement. Perfect. First, associate means what? Associate is a company where associate is an entity where we have the significant influence over it. Yeah, what is a significant influence? Significant influence can come with the voting rights. It can come with the as per the contract, or it can come with the because of the law. Right. So with respect to voting right, what do we say? If you have 20 or above percentage stake voting rights, then we can say it is assumed that we have significant influence over the other entity. But it is not like not necessary always, right? Even though you have more than 20 percentage, if it is proved opposite that you don't have significant influence, then you don't need to follow Ind AS 28. Then you should follow Ind AS 109, because when you don't have significant influence, then that investment will be falling under 109 normal investment. Next, if you have less than 20 percentage of stake, that is voting right, but you are able to prove that I have significant influence, then you don't need to, still you need to follow Ind AS 28, not 109. Okay, what do you mean by significant influence? Significant influence means we have a representation in the board of directors meeting. Okay, at the same time you may be participating in the policy making, right? You may be having a significant transactions with the entity, right? Or you may be giving a significant technical assistance or something like that. See, somehow you are able to influence the other company, then only you can say you have significant influence, right? When you have 0 to 20 percentage, as I said, it is generally assumed that you don't have significant influence unless until you prove it. If it is above 20 to above 20 to up to 50 percentage, it is assumed that you have significant influence. But if you prove it otherwise, then you don't have significant influence. Obviously above 50 percentage you have the control over it, correct? When you are measuring this, when you are measuring the percentage, then you are supposed to consider even the potential voting rights. Yeah, that means you have an option to purchase. But when do you consider this potential voting right? Subject to three conditions. The condition number one, you must be holding it as on 31st March. First. Second thing is what, you should be having some economic substance. That means by exercising such option, you must be getting some economic benefit, right? At the same time, that should be convertible or that should be exercisable as on the balance sheet date, not just holding it. The exercise period also must be within this 31st, as on 31st March. If you have a will, you should have, correct, you should have taken it up. Under that circumstance, you are supposed to take it up. You have to consider the potential voting rates also for the purpose of 20 percentage calculation, my dear. Okay, right. Equity method. Yeah, if you have significant influence or if you have a joint control, right? Now what is joint control? Some more than two parties will be, more than one, obviously two or more than two parties will be having an agreement that every decision will be taken unanimously. Yeah, that is, you require the permission of the all the parties in the agreement. Then that is joint arrangement. That is what joint venture, correct? Now joint venture, and the parties who are the parties to the joint venture agreements are venturers.
Yeah, so the venturer will be venturer also will be following equity method. Whether you are an investor, whether you are a venturer, then you will be following this equity method only. In case of equity method, what is the accounting treatment? At the first acquisition, first time when you are acquiring, normal journal entry, that is investment in associate or joint venture account, debit to cash or any other consideration you gave. Right. Subsequently, on the every balance sheet date, what are you supposed to do? There can be three situations that can come out. First thing is the associate or joint venture made profit. Right. You are supposed to take your percentage of profit. Right. What do you do if they make the profit? You should add the investment in associate or joint venture account debit. Okay. Two, share in profit. Share in profit of the associate or joint venture. This will be part and parcel of consolidated profit and loss above the taxation, above the profit. I mean, tax expenditure is there. Above that, you are supposed to present it. Suppose you made a loss. Yes. Then again, loss account. Again, correct. Now, share in our share of losses in the associate or joint venture account debit to investment is going to be credited. So you are reducing the investment and you are reducing the consolidated P&L. Suppose if the joint venture or the associate are giving the dividend to you, right? That means you are receiving the cash account debit to investment. Yeah, you will be taking your share of profit, that you need to remember. Suppose that if they make losses, yeah, if they make losses, what are you supposed to do? Yeah, you are supposed to reduce the investment, right? Is it only investment means investment in equity shares? No, my dear, you should accept the losses up to the interest in the associate is become zero. Interest in associate means what, sir? Interest in associate is investment in equity shares by the investor. Yeah, investment in equity, investment in debenture, investment in preference, any kind of investment. Yeah, that means you may be having, suppose investment in equity shares of associate, investment in preference shares of associate, investment in debentures of associate, in I mean long term loans given to associate. Everything is part and parcel of investment in or interest in associate. Okay, suppose if you get a loss, first which one I should reduce it, sir? You should first reduce it to the equity, investment in equity shares account you are supposed to reduce. Once that is khali, then you should go by preference share capital. Then you should go by debentures. Then you should go by loans and advances. Yeah, in the order of liquidity, in the order of less liquidity should be reduced first. More liquidity should be reduced. Right. That is the when if this associate company gets into liquidation, whom the money they will pay first, that for that money you should be reducing last. Okay, that is what you are supposed to do. Next, suppose that my associate has done the revaluation, sir. They have got a revaluation gain will be routed through OCI. Right, we should take our share of the revaluation gain, and in our consolidated profit and loss, that OCI or revaluation reserve should be in the consolidated profit and loss. Under OCI only you are supposed to present it. Okay, right. So that is the basic information, right? If the associate has got any cumulative preference share capital, then cumulative preference dividend should be deducted first. After deducting whatever the leftover, on that you have to take our percentage of profit. I hope you understand. If the associate has a cumulative preference share capital, you have to reduce the dividend. Then after that, whatever the remaining profit is there, on that profit, our percentage. Suppose we have 30 percentage, then 30 percentage is supposed to be taken. Next, unrealized profits. Yeah, unrealized profits. What are you supposed to do? You are supposed to eliminate it. Eliminate to what extent? To the extent of our holding. I have 30% holding. Total profit made is equal to 1 lakh. 1 lakh into 30 percentage. 30 percentage should be eliminated. Eliminated means you will be reducing it from the profit. Yeah, our share of profit may will reduce it. At the same time, I mean, in the concept, profit and loss impact will be 30,000 rupees, and investment also is going to be reduced by 30,000. Yeah, unrealized profit may be correct now. I mean, unrealized profit will be in the, it depends, the inventory is with whom. Inventory is with me, then I will be reducing it from the inventory. It depends on the, from, I mean, is it a downward transaction, is upward transaction. Next topic, different periods of balance sheet you have. Suppose your holding, I mean, holding company or investor company is closing books on 31st March, wherein associate is closing on 31st December. Yeah, generally we should say that associate financial statements also they should prepare as on 31st March for the purpose of our consolidation. But it may be possible, it may not be possible. Yes, but the maximum gap if it is not possible, if it is not practicable, see, I can't ask the associate to prepare financial statement for my calculation purpose. It may be not possible. Under that circumstance, what do I do? You can take it. If it is impracticable to do it, at least maximum 3 months gap should be maintained between the between the investor financials and the associate or joint venture financial statements. Yeah, but you have to ensure the uniform accounting policies. Here there is no exemption for you if they have correct. Now you have to ensure the uniform accounting policies. Next important point, very important point, classified as it is held for sale. Correct. If it is classified as held for sale, then you are supposed to apply Ind AS 105. A simple example, suppose I have 30% stake. Correct. Out of 30% stake, say 15% I wanted to sell it off, and the remaining 15% I don't want to sell it off. Now, the 15% which you want to sell it off, it should be measured at the book value or fair market value minus selling cost. Correct. Now, whichever is lower is supposed to be measured as per Ind AS 105. Right. But sir, what about the remaining 15%? Remaining 15% you are supposed to follow 50, even though it is 15%, that is, even though it is less than 20%, you still need to follow equity method. You still need to follow equity method because as on 31st March, we have not sold it. We have decided to sell it. So still I have the significant influence, but to the extent 15%, that means the associate profits into 15% I will take it. That will be added to the investment and to my consolidated profit and loss. Discontinuation by the discontinuation of equity method. When do you discontinue, my dear? Suppose I have 30% stake, I purchase another 25%, then it will become 55, then I got a control over it. Or I may be having correct 35%, 30% I have it, I sold off 15%, that means I have got it became 15%, then I lost significant influence. So whatever the reason, you may be losing the significant influence, then you know you don't need to follow equity method in the consolidated financial statements from then onwards. Then, sir, I have already made a revaluation reserve. I have already made some foreign exchange currency translation reserve. Correct. Now, so many things were there, sir. Right. Assume the relevant asset has been sold off. I repeat once again. Assume the relevant asset has been sold off. What do you do with it? Suppose one fixed asset is there, which is which for which we were following revaluation model, and we sold it off. Okay. Then what do you do? The revaluation reserve would have been transferred to retained earnings. Then do now also. Correct. Now, what are you supposed to do? Your revaluation reserve, which is arising because of the associates revaluation model, that should be transferred to consolidated retained earnings. You are supposed to transfer as if the respective asset or liability has been closed. You are supposed to deal with it. And with respect to impairment loss, then obviously if your asset if your associate is not doing good, or if you feel that you will not be able to recover the money, yes, normal Ind AS 36 impairment rules and regulations should be followed. Right. I hope you got the point. Thank you very much. Wish you the very best. If you like this, please share it with your friends. Let this be useful to as many people as possible. Thank you.